Opportunities in securitized assets, have really increased as we've gotten through this year. And it's, this chart here that we have up really tells the story. And you can see the gold line is investment grade corporate bonds, the red dots treasuries. And you've seen over this year, and really over the last several years, yields on high quality assets have come down while the risk, which is on the bottom on the x-axis, has increased. So what we like about securitized assets in these markets is that they provide yields that are competitive to corporate bonds, significantly above treasuries, with a lot less risk. So a lot less interest rate risk and really spread risk. The two areas that, the sectors where we have overweights and emphasis in some of our portfolios are two areas: MBS, mortgage-backed securities, both non-agency and agency, and CLOs. The area non-agency that we've increased and we really like is the non-performing loan space, and these are pools of non-performing loans. They offer yields above 3%, and they're very short. So on average, the average life will be anywhere from 1 to 2 years, and they have limited risk of extension, and meaning extension that the average life will be longer than 2 years through coupon step up. So if they extend about longer than 3 years, the coupon typically steps up 300 basis points, which is a huge incentive for the issuer to call them bonds. So again, a lot of yield, short average life. The other area is CLOs, and CLOs have the underlying is leveraged loans, and there's been a lot of leveraged loans in the credit space. There's been some pockets of leveraged loans that have been an issue from a credit standpoint, but these are a lot of what we're emphasizing on are new issue CLOs that have low exposure to the industries and problem credits. And really what you have here is structural protection, meaning that the AAA and AA CLOs that we invest in, you would need a significant amount of defaults across individual names and industries over time to incur a dollar of loss. And again, all these opportunities here, the common theme is that they're very high quality, meaning very remote risk of incurring a dollar of principal loss. Now you could have some price volatility, due to just general market volatility like we had in the March period. But these sectors, again, very low risk of incurring a dollar of principal loss. So when you do have periods of price volatility, they tend to, it's very short-lived and creep back up to par pretty quick. You had an event where, I think in a 1 week time frame where long treasury bonds, gold, equity, all assets were down in price. So again, a huge liquidity event, but again, there was pretty quick recovery with the underlying. So within 3 months or so, you had most of these sectors back to trading, very near where they were pre-COVID crisis. And the RMBS sector, one of the reasons too we really like that is just the underlying is associated with the strongest part of the U.S. economy right now, which is housing. So the non-agency RMBS, the credit risk, and again the risk of principal defaults is pretty low given the underlying asset in those pools is housing, residential real estate, and home prices are continuing to move higher. And again, it's the strongest part of the U.S. economy. The things that we're looking at is there's two things: is really the structural protection and versus what we think expected losses are going to be on the underlying assets. And again, when you look at CLOs, the amount of structural protection, the amount of losses that you need to incur before you have a risk of a downgrade or even a principal loss is just significant, to the point where, again, if you do have a problem with these at that point, big parts of the fixed income and equity markets are going to be in much deeper, have much deeper issues. The way we look at it is it's really alternative fixed income. So these are sectors of the market. A lot of them are, equity type sectors that have yields that are comparable or much higher than high yield. So it's a way to get yield relative to relative to bonds. And the areas that that we're most focused on, it's 6 different sectors: closed-end funds, preferred stocks, convertible bonds, high dividend paying equities and REITs, MLPs, and BDCs. The 3 areas that we like the most, one is closed-end funds, and closed-end funds right now are yielding 8%, between 8 and 10%, based on a portfolio of closed-end funds. And what we like about that space is that they're still trading. They've recovered a lot from the COVID period, but when you look at them on a discount to the net asset value of the funds, they're still pretty wide relative to where they were pre-COVID. And given a couple things with closed-end funds, one is they do, about 60% of the index or the universe are fixed income related funds. So they're backed by high yield bonds, emerging market bonds, or high quality bonds. And they do have leverage, some underlying leverage that allows them to have dividend yields that are 8+%. But given the yield plus the discount to the NAV, if you get a little bit of narrowing, normalizing of the discount to NAV, you can easily paint a picture where you're going to get returns that are 10% or higher over time, and some good dividend yield. If we just sit here and there isn't any compression of the discount to NAV. Mortgage REITs and BDCs are just leveraged parts of sectors that we invest in the fixed income sector. So mortgage REITs are it's a levered play on agency mortgages, which we're big investors in agency mortgages and non-agency mortgages. So we understand the underlying, these are just levered vehicles that invest in that underlying. And, they were, hit very hard during the COVID period, and it's really, they're levered vehicles. So a lot of the mortgage REITs face margin calls, and we're down a lot in price and had to delever. But where they're sitting now is, when you look at them on a price to book ratio, they're trading pretty cheap on a historical basis. And again, if you just get some normalization, some steepening of the yield curve, these can, again, the yields that they're kicking off are 10+%, and you can again also get some capital appreciation just from the narrowing of the price to book ratio or improving of that. BDCs, a couple comments, very similar story is that BDCs, it's a levered credit play. BDCs are specialty finance companies that own private debt, and they're same thing. They're trading on a price to book ratio that is below cheap to historicals, and it's a way to play the eventual recovery of credit markets. Now again, we're not through this market cycle yet, but we're still, the next year is probably there's still going to be some periods of volatility. But as you come out of the market cycle, these BDC investments, again, have a lot of yield, and you could get some decent price appreciation on them. And how we look at these is, that there are ETFs that you can invest in mortgage REITs and BDCs. But what we do is we leverage our analysts and our quant teams to identify baskets of securities that we think have the best return potential. And that's how we invest in those spaces. the closed-end fund space, we have a quantitative model where we're screening, looking at all closed-end funds in an index in the market that are of a certain size. And then we're screening those down into, a portfolio, smaller portfolio of we think that have the best relative value. And when we back test our model, the difference between owning the top 30, like of what we screen, and then the bottom 30, just not owning the bottom 30 names in an index can mean a huge return difference. Again, just avoiding the losers in an index can point to again a big return pickup.